Good morning, options traders. Well, I thought this would be a perfect time to add an important perspective into the market and what's happening right now during the coronavirus pandemic. And when you're looking at these stock prices that are pushed to unbelievable lows, that they're not really as bad as they seem. And I know people are going, what do you mean they're not as bad as they seem? Stocks are coming unraveled. Well, there's a reason, and it's not for the reason that you think. It has to do with risk, premiums, and discounts. So this is an important topic in really all of finance, but especially when you're trading options. You have to understand which type of market you're in. Is it dominated by hedgers or speculators? And it's going to give you some key insights into the extrinsic values that you're either paying or receiving. So you have to understand that every single market is made up, and I'm simplifying this just into two key players, into either hedgers or speculators. And a hedger is somebody who wishes to offset an existing risk. So if you have, let's say, shares of stock and you buy a put option as an insurance policy, you're acting as a hedger. The shares of stock in your account are an existing risk and you're trying to reduce that. You're acting as a hedger. On the other hand, speculators are people who seek profit by accepting risk. They'll actually step in and say, I'm willing to take this risk, but I'm doing so because I'm trying to search for profits. So let's say the person that might sell a naked put to you, the person who's trying to buy it, would be acting as a speculator. They're accepting risk in search of profits. Now here's where it gets interesting. If a market is dominated by hedgers who are wishing to sell, then discounts are created. On the other hand, if a market is dominated by hedgers who are wishing to buy, then premiums are created. And it's these discounts and premiums that create the incentives for the speculators. I know it sounds like it can be a complicated concept, but let me start off with an easy example. Let's take a look at a used car market. So let's say you pull up with your car here to Honest Abe's Used Cars and you say, I want to sell my car. And we agree that your car has what we might call a fair market value of $10,000. We both agree this is the price that you could list it in Auto Trader for and probably get within a few days. So again, think fair market value. Well, the dealer is not looking to offset a risk. In this case, he's acting as a speculator. He's buying this car in search of profits. Makes no sense for him to spend $10,000 for it and turn around and sell it for 10. Can't make anything. And in fact, if he can't get 10, he might lose. So what's the incentive? Or where is the incentive? The incentive comes from him saying, I can't give you 10, but I'll give you 9. I will discount it. And if you agree, he now has a profit motive. Now that doesn't guarantee he's going to make a profit, obviously, but at least he has the incentive. However, let's say that the same car, for some reason, isn't selling as well. And the dealer says, yeah, it's in good shape, it's got low miles, but you know what? They're just not selling. I might have to sit on this thing for 6 months, and who knows what I'm going to get. There's a bigger risk. So I can't give you 9, but maybe I will get a bigger discount and offer you 7. I'm creating a bigger discount to reflect the risk. So if you can understand the role of a discount, it'll be pretty easy to see the role of a premium. So let's take a look at how that might occur in, let's say, the futures markets. This is a very common concept in futures markets. And let's say that these are the months across the bottom here, and these are the prices of certain commodities. So let's talk about maybe wheat. And let's say these are the prices of wheat contracts for the next 6 months, let's say January through June. And this is where everybody thinks wheat prices will be. So maybe we start at $3 a bushel in January and they go up maybe 10 or 15, 20 cents each month. This is what the market thinks. Now, what would you think would be the prices we would see in the markets? Are these the prices? That's kind of what you hear with futures markets. It's the price that everybody expects to see in the future. That's not true. It depends on which side of the transaction, the hedgers or the speculators, are dominating this market. So let's start off with, let's say, maybe it is a seller. Let's say that this market is dominated by farmers. which is often the case with a commodities market. So we have farmers who are growing wheat. They are going to be a seller in the future, so they want to lock in their price. We all agree these are where the prices are going to be in the future. What are we going to see in the futures market? We're not going to see these prices. We're probably going to see these. Why? Because in order for the farmer to sell the futures contract, he needs a buyer. And that buyer is a speculator. And that speculator is going to discount these prices so that they can have a profit incentive over time. So in the futures markets, this happens a lot. It's actually what's called a normal backwardated market. I know it's a horrible term, but it just means that the prices of these futures contracts are expected to rise over time. And that's because the market was dominated by hedgers who are sellers. But now let's take a look at that same market. Again, these are the wheat prices and where everybody thinks they're going to be over the next 6 months. But now instead of sellers, let's say farmers, let's say this market is dominated by buyers. Maybe it's Kellogg's and a lot of people who want to buy wheat in the future. And they are the dominating players in here. What are the prices that we're going to see? We're not going to see these here in blue, even though that's what everybody thinks. If we look in the futures markets, we're going to see these. They're going to be priced at premiums. Why? Because the buyers are willing to pay a little bit more in order to entice a speculator to take the short side. And when speculators are short, they can now expect these prices to fall in the future and therefore have a profit incentive. So it all depends on which market is dominating at the time as to whether we have premiums or discounts. So keeping this in mind, think of what's happening right now. So here's Apple, and it's trading for about $252, very, very low prices from where it was just over a month ago. And a lot of traders think, oh, this is what the stock is going to be worth. This is what we hear a lot, that it's the expected future value of the cash flows of this company. Sort of true, but we also have to account for the risk. So think about it. Who is dominating this market right now? Is it buyers or is it sellers? It's sellers. People are scared to death. They are trying to get into cash. So who's on the opposite side of the transaction? Speculators. Why would a speculator step in and buy under these conditions? Because they are putting enormous risk premiums on these stocks. Think of it just like with the used car. So yes, we see that the stock price right now is $253, but if this was really the, let's say, the fair value of the stock, why would a speculator pay $253? He wouldn't. The fair value of the stock is probably more up around $275 or $280. But it's just that people are requiring such a big risk premium to step in and take the other side of the trade. So hopefully this will help you to keep a good perspective in a market like this. You have to realize it is dominated overwhelmingly by sellers. And yes, you can always get a speculator to step in and buy if the price is right. So this is also why markets like this often come out of here in a V bottom in almost all cases. And that's because once that risk premium disappears, we see these very sharp spikes. It's not because the company suddenly becomes worth that much more. It's just because the risk premiums are quickly vanishing. So hopefully this helps to keep a little bit of a perspective in markets like this. If you want to sell, that's fine, but don't do it because you think that this is what the stock is worth. It's worth a whole lot more than this. The main reason the prices are down here is because of the enormous risk premiums created by the coronavirus pandemic. And as a little experiment, take a look at that when we come out of this, which is a matter of time, it is most likely going to be a V bottom. Why? Because that risk premium, when it vanishes, is going to pump another 30% in these stock prices immediately. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.